Hello, everybody, and welcome to another one of IRONSHIELD Financial Planning's Fly on the Wall webinars. For those of you who don't know me, my name is Scott Plaskett. I'm a certified financial planner and the senior financial planner and CEO of the fee-based financial planning firm IRONSHIELD Financial Planning. If this is your first time tuning into a Fly on the Wall recording, let me quickly explain to you what this is. You're going to experience what it's like to be a fly on the wall during one of my update calls with a member of our Top Guns network. This network is my personal network of specialists. Every so often, I ask a member of my network to touch base with me to bring me up to speed on the latest happenings in their area. And when they call me, I record the call so you can be a fly on the wall for that call. On today's episode, I invited Mike Flux, Senior Vice President and Portfolio Manager at Connor Clark & Lund Private Capital, to chat about their investment outlook. We also discussed how to interpret the current events and how to properly position portfolios to take advantage of these market events. He shares a very well thought out and disciplined approach to investing in today's environment. Now, here's the call. Mike, I want to thank you for taking the time today to go through this new asset class that you're bringing to the table with through Connor Clark & Lund, which I think is really interesting. Interesting in the sense that from a timeliness, it's perfectly timed in the sense that we've got an environment right now where interest rates are at historic lows. We've seen the Feds in December of 2016, they increased their core lending rates. And so we're starting to see the I don't know if we're at the point where we're seeing the transition, but we're sure close, I would think, with the interest rates potentially on the upward movement, so to speak. And that's a concern. That's probably one of the biggest concerns from a portfolio construction standpoint is when you're balancing a portfolio and not putting everybody into equities and you're, following a prudent path and diversifying amongst different asset classes. The problem that we're faced with right now is we have fixed income portions of portfolios in traditional bonds. And every time there's an interest rate increase, those traditional bonds have a devaluation effect. They go down in value. And if we see that coming from the lowest interest rate environment we've ever been in my lifetime, and we start to see that interest rate begin to move back up, we got a problem. Portfolio managers are going to be, there's a headwind, a major headwind against that side of the portfolio. And so it's the creative juices that start to get flowing from a portfolio construction standpoint to say, okay, where can we start to allocate that portion of the portfolio so that we can remove the risk that is so very well established and we know it's right there. We can begin to reduce, remove, or mitigate that risk without sacrificing return. Because at the end of the day, I think one of the real risks for people who are kind of on the do-it-yourself fence is they're taking a look at their portfolio today. They're seeing the stock side of the portfolio and saying, hey, it's doing pretty well. They're looking at their traditional bonds and going, okay, it's not doing that well. I want more stocks. But what they don't realize is that they're attracting so much more volatility and so much more risk to their portfolio by doing that, but they really don't have any other alternatives. It's these other alternatives that I think are so important to incorporate into the discussion. And that's why I'm excited about the conversation we're going to have today about the introduction of the new CC&L private capital, private client loan portfolio. So I'm just going to pass it over to you and just sort of let you sort of go through a bit of an information session on exactly positioning what this asset class is all about.
That's great, Scott. Thanks for having me, and I do think it's timely. You've already touched on some of the points I'm about to make, but just as a reminder, not everybody that's dialing into this call is necessarily working with us, so I just want to give a quick synopsis of who Connor Clark & Lund is, kind of clients we deal with, and then move into the business case for why we're getting into the private loans business. We've been at the money management business now since '82. We now manage over $70 billion for larger institutions like pension plans, foundations, endowments, and then we've got a high net worth client business where typically our clients are in the 1 to 10 million range, but we have clients well above that mark and some below that mark as well. In the private client world, we manage a little bit over $6 billion now, $6.2 billion, about 2,000 clients. So that kind of gives you a sense of the average client, about 3 million. And the more money a client has or an institution has, the more sophisticated they want it to be about how they manage portfolios. So we've really tried to morph ourselves into becoming the biggest independent multi-boutique that can bring a lot of different things to the table, not just stocks, bonds, and cash. Like I said, we deal with pension plans, foundations, endowments, all kinds of high net worth clients. We've been at it since '82, so you can see all the types of things that have happened during that time: stagflation of the early '80s, banking crisis of the early '90s, dot-com crash of 2000, the recent credit crisis, the European debt crisis that really peaked out in 2011. Now we had two global market corrections inside of the last year and a bit. We had the Brexit vote that went counter to people's expectations. We got Trump as president, right? So there's lots of stuff going on, and we got to find ways to reduce volatility for clients because they do want to preserve and grow their capital. And gone are the days where you can just rely on traditional fixed income. You know, the 10-year Government of Canada bond has dropped to an all-time low. It went down to below 1% recently. Now it's popped back up because the U.S. has raised rates. Not to our surprise, we've been planning for this for some time. But the U.S. has also stated they're planning another 5 increases over the next few years. And who knows whether that will actually come through or not. And who knows when Canada will actually follow suit and start to raise rates. But the expectation is that the U.S. will raise rates more this year in 2017. And Canada will likely follow suit with some kind of increase of its own at some point in time. Otherwise, our currency is going to get further devalued. And you know, as you say, when interest rates move up, bond prices go down. You know, you get some examples going back to 2000, 2005, 2010, 2016, where this did happen. Just recently, interest rates just went up a quarter point in the U.S. and bonds lost about 3 or 4% of their value. Core bonds, conservative ones, within a couple of months. So it's been a fairly volatile time for bonds. And this is something we've been talking about needing to deal with for some time, interest rate risk and interest rate sensitivity. So we'll talk about how we can address that through this portfolio. The other thing you mentioned, Scott, was that stocks, stocks should do better, but you can't just dial up your exposure to stocks because there's higher risk attached to that. And we've been in a pretty blessed environment where the volatility of a typical balanced 55-45 portfolio, say, has been well below what you might normally see for a market portfolio. And you can see how the long-term average of a balanced portfolio might be around 7.5% risk or standard deviation, the way we measure it. Times like 2008, it spikes to crazy unprecedented levels. 82, the stagflation periods, it was high. It was really high during the tech wreck. All these times where we saw volatility, it does spike up, but this is what's transpired since March of 2009. Up until 2015, where we had a global market correction in August, September, that means a 10 to 20% sell-off in the markets. We had another one of those in January, February of 2016. We had some volatility around Brexit, some volatility leading up to the election. During the election, it was crazy. The markets were down 900 points at one point that evening of the election. Next day, markets were up over 200 points, so a pretty wild swing to the positive from one day to the next. But what it means is you need some tools in the toolbox that will help you to manage risk and return. So as a firm, we built a comprehensive platform of stocks, bonds, and cash, which you can see under the traditional section. We offer more diversification than most firms in the marketplace in this regard, with all of that talent in-house, so we can really control it, monitor it, make sure that everything's working well together. But we've also learned our lessons from other smart money institutions out there like OMERS, Teachers, Yale, Harvard, CPP, Canada Pension. And what are they doing? And for years, they've been investing in a lot of creative alternative ways like hedge funds, commercial real estate, energy infrastructure like solar, Run River Hydro, traditional infrastructure like schools, hospitals, highways, private equity where returns might be expected to be 20+% over the long run, commercial real estate, infrastructure maybe 8 to 11. Our hedging strategies, we have a goal of 6 to 8% gross returns there. Compared to bonds, where truthfully we probably expect more like a 1 to 3% return in the next 5 to 10 years. Stocks, we would have maybe said 7 to 9 at one point. Well, now we're probably thinking more like 5 to 8 in the short term is more reasonable given where we're at. With private loans, not to get too far ahead of it, but our goal there is to generate 7 to 9% returns, around 8% on average before fees, which presents a pretty compelling risk-adjusted rate of return proposition relative to what we'd find in the traditional space. Bonds 1 to 3, stocks 5 to 8. This portfolio 7 to 9, 8 on average, with a whole lot less risk than stocks, a little bit more risk than normal bonds. quite an interesting value proposition.
Yeah, well, I think the last slide you had there was, really just speaks to the fact that right now, portfolio construction needs to have other tools in the toolbox. And so if the toolbox that's being brought to the table doesn't have the discipline and the other components available within it, not to say that every tool is meant to be used all the time, but it's nice to know that when you need to tap into a certain tool because there's a certain economic event or something taking place or some sort of a super trend that's in the marketplace, that you've got that available to you, that you can turn to it. Otherwise, you just kind of have to watch that opportunity pass you by. So it's great to see the different components, like all those boxes. There are different tools in the toolbox. So it's important to have that diverse toolbox available to you.
I think one of the things that separates us from a lot of our respected competitors is that we really do believe and act on the belief that clients should be diversified. And our definition of diversification is not just a basket of 20 stocks. It means getting diversified across all the asset classes, both traditional and alternative, public and private market. That's what the pension plans are doing. They've got deep pockets. They've been at it for a long time. They're very sophisticated. We've learned our lessons from what works in that world. And not that every client has to participate in alternative just because pensions are doing it, but at least we have the tools available in the toolbox. And so when times are tough in the traditional markets, in the stock and bond world, at least we've got somewhere that we can go. So what is a private loans investment? Well, first of all, let's cover the opportunity. Globally, private loans, what we're talking about here is that we're lending, I'm talking about the top right where it says portfolio loans. We're looking to originate, underwrite, and manage a portfolio of secured loans to mid-market companies. There'll be approximately 20 loans that we're going to build into the portfolio over time. The term could be anywhere from 2 to 10 years in terms of what we'd be lending the money out at. We're looking at businesses that typically is generating more than $10 million a year in normalized earnings, profits, has maybe $100 million plus in assets. So, and they've been around for over 5 years. So we're looking at good established businesses. These kind of businesses are actually bigger than the average kind of business that we might buy into in our private equity market through Banyan Capital, our private equity partner. So these are good quality businesses. We'd be lending money out to them and hopefully generating yields in the upper single digits or double digits, gross of anything, like gross of any fees. But on a gross basis to clients, what they might expect is about a 7 to 9% return, or 8% on average. So when you look at that 7 to 9% per annum yield expectation, and the fact that there's a significant opportunity right now, because globally it's a very well-established asset class, but in Canada, supply is pretty low. There's not a lot of providers of this. And what's also happened recently is that financial regulations have weighed in and made it way harder for traditional lenders to make longer-term structured loans. So when you look at the supply and demand, and you look at the opportunity, the relative opportunity in the stock and bond market, we think that this is a pretty good time and opportunity.
So really, what I'm hearing from you then is that there's a couple of of interesting points that are happening right now. First is that it's the right time to be looking at this, because if we don't have something like this included into a portfolio, then as we said before, the traditional fixed income approach is just simply you're going to start to see that the performance that part of the portfolio is generating for the portfolio is going to reduce, which means there's going to be more reliance on the equity side, which means you're just simply, in order to get or aim for a higher return, you're going to have to take on more risk. So this allows us to feel confident by moving, a slight portion of the portfolio into this particular asset class. It's going to generate, or it's ideally suited to generate, a decent return. We're not looking to beat a stock portfolio. We're looking to maintain what a good diversified long-term bond portfolio has done in the past. And that's what this is showing. On top of that,
that's right.
We've got the fact that there's the opportunity that there aren't that many people doing this. There aren't that many opportunities to participate in this asset class, because in Canada, it's, I guess, would you say it's fairly new?
It's a fairly new asset class. There's not a lot of people providing it, right? So it is relatively new in Canada, because the banks used to lend this kind of money, but things have changed from a regulation and a demand standpoint. The banks tend to lend in different ways now. So that means these private companies, they either have to issue equity, which essentially means they're parting ways with their 20+% returns.
They don't want to do that. Yeah.
But in some cases they do for the right kind of partnership, and that's why we have a private equity group that does that. But in most cases, better bang for the buck is to issue debt, or to engage in private loans, where maybe they are paying 10+% in some cases, which is a lot more than what the current banking rates are. But it's still a whole lot better than giving up their equity.
Right.
So, and when they look to partner with a firm, the fact that there's a firm like Connor Clark and Lund that manages $70 billion, manages money for Canada Pension Plan, has a private equity group within it. We're the biggest independent money manager in the country, and so I think that lends itself well to people coming to us for this. Plus, what this slide is showing is that we're not just looking to create this from scratch. We're bringing in a team with lots of experience. Tanya, Jeff, and Jason are formerly with GE Capital. They're now called Midstar internally at our firm. That business ultimately got sold to Wells Fargo, but they've worked together for over 10 years. They've originated more than $15 billion in loan opportunities across Canada, they invested in a diversified portfolio which peaked at over $3.5 billion. There's a lot of talent, a lot of bench strength here, and they joined us in October. Helped us to kind of finalize building out a structure where we can start to raise commitments for them to go out and shop for these kind of loan opportunities. And already they've looked at probably 20 different loan opportunities, and they're ready to make their first investment later in February. So what we're looking to do here is educate individuals about this. For people that are interested, kind of come up with a commitment amount that makes sense. We would typically say about a 5% allocation out of a portfolio makes sense here. And that would typically come out of core traditional bonds, or maybe even high yield bonds. So that we're just moving from fixed income to fixed income, but it's a different kind of fixed income. So that's really the intent of today's call, is just to set the stage for what we're doing and get people thinking about, is this something I'm interested in? What's the percentage allocation I want here? And what does that mean in terms of a dollar amount? Ultimately, we'll have to sign paperwork that locks in a commitment, just like with real estate and infrastructure, for any clients that are familiar with that process with Connor Clark and Lund. But you make a dollar commitment, then the team goes shopping for investments, and in over 2 to 3 years, we can build up to that fully invested position.
Right. So what you're saying is that we can say, yeah, we'd like to have a 5% commitment to start, for example, a 5% commitment, but that doesn't happen overnight. You've then said, okay, I'd like to ultimately have a 5% commitment, and then that puts the dollars aside for Midstar to then go and make those investments. But we don't get participation in those investments until the investments are made. So it's not like there's a pool sitting there that we can just buy into, and then all of a sudden we start to generate the benefits of that. We've got to actually become, partners with Midstar, put the money in, and then it ultimately gets released into the marketplace over whatever time frame they can make it happen.
Yeah, no, this is kind of simplifying it a little bit, but let's say somebody wants $100,000 in this portfolio and it's going to come out of their RSP account. Well, if we're going to have 20 investments in this portfolio over time, then maybe in February there's a 5% capital call, because and so we'll need $5,000 out of that 100. And over the next 2 to 3 years, we're going to have a number of loans that we close out on. So there's capital calls, ranging anywhere from say 3,000 to 10,000, say. But over 2 to 3 years, we get the full 100,000 invested.
Right.
That's essentially how it would flow.
Right. Okay. Yeah, it makes total sense. And then at that point, we can reevaluate where that section of the portfolio is positioned from an exposure rate in the plan, and if we feel that we want some more exposure, we can always increase the allocation at that point.
Yeah.
Yeah. Good.
There's a little bit more information on the dynamics. Maybe people have read this while we were rambling on. But supply is low. The Canadian banks, for regulation reasons, are able to lend a little bit less. They're lending very cautiously. They're actively deleveraging their loan portfolios. They're focused much more on high yield or distressed opportunities versus us. We want more stable. businesses that we're lending money to. Banks are targeting private equity-owned companies. We're not necessarily targeting that. We can, but we're not necessarily competing. And with GE Capital leaving, they were a major competitor. Now they're part of a U.S. organization, and another firm, CIT, exited. There's really not a lot of supply out there. But there is a lot of demand, and there's investor return thresholds. We got a low interest rate environment. It's going to be rising. Stock markets are more volatile. So this 7 to 9% return opportunity is something that we think we personally find attractive for our own money. And then I mentioned the regulatory requirement as well. So it's, everything's really pointing in the direction that, there's an attractive yield here. A lot of these interest rate loans are going to be based on a floating rate, providing a nice inflation hedge. When interest rates move up, inflation tends to move up too, so that's going to help. This asset class has a very low correlation to traditional stocks, bonds, and cash, which makes it a good diversifier. We feel that our active approach and the experience of the team will lend towards a nice protection of principal approach. So bottom line is it's all about producing attractive risk-adjusted rates of return and protecting capital. And we feel that we're the firm in partnership with Midstar to do that. So risk-return profile, for clients that are familiar with the Connor Clark & Lund platform, it is a little bit riskier than our standard core bonds and our multi-strategy portfolio, which is a market-neutral fund that we manage. That's one of the alternative tools that we use as an alternative to manage fixed income or interest rate risk. But it's also less risky than real estate, infrastructure, any kind of equities, and private equity. So we look at this as a component of the fixed income portion of the portfolio. And if you just look at positioning private loans in the context of bonds, obviously distressed lending is going to be the highest return if you do it well, but it's also the highest risk. And grades at school, of course, you want your kids to get an A or an A+. B+ is pretty good. C+, you're really not that happy. D, you're ready to kick them out of the house. So, where we want to be positioned in private loans is kind of right here. So it's going to be a little bit more risky than just holding a Canadian bank, which is a no-brainer buy some of the time, but you're also not going to get the same level of return, in particular in today's market. The government of Canada is only paying a little bit of a 1% right now. Banks, in a blended portfolio, you're only getting, we think 1.7 might be a reasonable yield in a core bond portfolio. So here we're looking at triple B to B, so like a B to a B+, but you're also going to get rewarded with 7 to 9% return opportunity, which we say is quite attractive. And when you look at the risk-adjusted return of this versus, say, mezzanine or distressed, we'd rather take a lower return with way more stability, in our view. We're not a firm that likes to bet the farm and swing for the fences. Our clients have typically worked very hard to earn their money, and they want to keep it. And they don't want to have to come out of retirement and work at Walmart as a greeter. So we're just not willing to take undue risk. This summarizes a lot of things that we talked about. So I'll just pause on this page for a little bit, and we can certainly deal with any questions that you might have. But in a nutshell, good established businesses that have been around for 5+ years, 10 million a year in earnings or more, 100 million plus in assets. They're looking for money. We'll lend them 3 to 6 times their normalized earnings. So that could be anywhere from $20 to $60 million would be a typical loan. The rates to the borrowers could be anywhere from 5 to 12% plus additional fees to originate this. The term of the loans is anywhere from 2 to 10 years, which is less interest rate risk if you think about it versus, say, a core bond portfolio where the typical maturity or duration is going to be 7 to 9 years. We're going to have a lot of collateral against these loans. We're going to have first liens in many cases. So if the organization has 100 million and we're lending 20 million to it, we're going to find a way to get our money back, even if it hurts the business. That's the nice thing about lending money. When you hold equity, you want the business to survive for the long term, and we want that too. But when you're issuing a loan, you're highest up on the pecking order. So, for us to lose money, all the equity shareholders have to lose a lot more or lose everything they put into it.
Yeah, well, I mean, it's a great asset class, and it's I think I just want to highlight that it's not something here that's meant to replace the traditional fixed income, because there's still going to be a need to have some exposure to that. I think it's not that asset class is now not appropriate. It's just there's some challenges with it that we want to diversify out of a little bit. And so by moving to something like this, it's really just saying, look, it's fixed income to fixed income. It is, as you say, a little bit more inconveniently liquid, so it's not meant for sort of somebody who needs to get their regular cash flow from the investment. But it is something that will, over the long time, just help allow somebody to maintain a proper risk profile without sacrificing return. And so if we can bolster that side of the portfolio with other asset classes that kind of keep that yield coming in to the portfolio, then we don't have as much reliance on the equity side to make that nice, decent, stable, consistent rate of return. So that's why I quite like this. I like the introduction of it. I like the inclusion of it. And I like how it complements an existing portfolio, that it's not overlapping anything. It's just simply complementing and helping us diversify the fixed income part of a portfolio.
Mm-hmm. And I agree. That's a great summary, and that's maybe a good place to end. Here's a little bit of a legal disclosure that I'd like to share with you. Just talking about how this is just information provided by Connor Clark and Lunn. But we do think that this summarizes the asset class and opportunity. And on a risk-adjusted basis, we think it's attractive. It's not meant to be a complete replacement for bonds, but for the foreseeable future, we don't think core bonds have the same potential. There will be times over the next 5, 10, 20, 30 years, many times, where core bonds are the top performing asset class. So we're not saying eliminate it just because interest rates are low and rising and recent numbers have been weak, but we are saying at this point it does make sense to diversify, manage that interest rate risk, because we are moving into a rising interest rate environment. And here's an asset class that works a little bit differently, quite favorably. And for our own money, as partners of and owners of Connor Clark and Lunn, we like this asset class a lot. And so we're making it available to our clients to ride alongside us. And for anybody that wants to talk a little bit more about their specific circumstance, I'm happy to engage in a conversation with you and your clients.
Yeah, well, that's great. Well, I appreciate you taking the time to go over this, because I think it's an important discussion to have, especially now that there is that turn that's taking place in the with the interest rates, and anything we can do to help protect against that is great. So this has been a great summary of that, and you're right. Anybody who wants to find out some more, just give me a shout, and we can arrange to get some more information available. Thank you for listening to today's call. If you require further information or have a question relating to today's call, please go to the comments section in the show notes below. Ask your question or make your comment, and we'll respond directly online. If you would like to take advantage of a free, no-obligation appointment, please call me at 416-626-6515. Or you can visit us on YouTube by checking out our YouTube channel, youtube.com/IronShieldCFP. Follow me on Twitter, twitter.com/IronShieldCFP. Like us on Facebook, facebook.com/IronShieldCFP. Or you can connect with me on LinkedIn.